When you think about what's going on in the world today, I mean, everybody watches the news. You've got continued geopolitical tensions with Russia's aggression towards Ukraine. That hasn't slowed down yet. You've got global supply chain disruptions and sporadic COVID lockdowns still taking place in China. They're having a bit of a rough time in China at this point with the way they're locking everybody down. You've also got inflation. It continues to move higher when was originally expected to be actually waning by now, but it
Or
hasn't.
at least slowing a little bit.
Yeah, it is. What's causing it? Well, ongoing price increases for energy and many consumer goods. And think about it this way. When you're talking about energy and you're talking about gas prices, which everybody is feeling, because now in Michigan we're well over $5 a gallon for gasoline, and for when you get into diesel, we've topped the $6 mark at this point. So when you think about it, our country runs on energy. It runs on trucks, and the trucks, if they're going to have additional expenses, that's going to get passed on to consumers. So that's why some of the consumers' goods are rising so fast. You've also got, with all this inflation, increased volatility in the financial markets. We said it in the beginning of the year that we certainly believe that we'll be positive before the end of the year, although when you look at things right now, you may not think that could happen, but it happens more often than many think. But we did say that there was going to be increased volatility. So the mature investor knows how to ride these things out, but we'll talk about strategies today that will help you actually end up on the other side in better position. Now, you've got the U.S. labor market. Home sales and consumer spending still remains strong. So that's a big deal right there, since the consumers are about 70% of the GDP, and it's not waning at this point. Then you got central banks considering more aggressive rate hikes to slow inflation. Any rate hike is going to make a move in the market for sure. When you think about it and go back in time to March 2020, this was back when we were basically in lockdown. Our country was in total lockdown at that point. It was kind of a self-induced recession. And towards about, I believe it was March 23rd, we hit the low point in the market correction. But this is what the speedometers look like. When you're thinking about things from an economic and financial standpoint, this was looking rather dire. But you fast forward to February of 2020, and the leading economic indicators were looking, goodness gracious, almost all green. Everything was very positive at that point. Matter of fact, it was like that for months on end, which was really unprecedented. Then let's move forward to where we are today. Now, many people, if you read the news, you would say, oh my goodness, we're back to March 2020 catastrophes, but that's really not the case. When you think about it, we've got 9 green, 10 yellow, and 1 red, and that's still a very positive economic and financial forecast. And again, when you're looking at these indicators, we're looking at 6 to 9 months out on the indicators. So we think that we're going to have a pretty positive end of year. Again, even though we did hit the correction mark. And if you think about it also, when you're watching the geopolitical events, there's a little bit more of a heightened degree at this point. And certainly all eyes are on the Fed to see if they can slow the economy down.